Hey folks, Andrew Packer. Welcome to Trading Tips. Want to talk more about news events and how you can trade them for profit. Now, we've already looked at several positive things that occur as news announcements that allow companies to see their shares go up over the coming days, weeks, and even months. But there are a few news developments that when they come out, they might not necessarily reflect the fact that they tend to be bad. And by tend to, I mean most of the time you'll probably see shares fall as a result. They might go a little higher, they might not. You never 100% know with investing, of course, but there are a few things where if you see a company make this kind of announcement, you should probably just avoid it and look for somewhere else to put your capital. So this is kind of what I call the bad news announcements. And the first bit of bad news is a new company headquarter. And the reason for this is a company will announce really during the boom times that everything is going well, that they're expanding, that they have all these new employees and they need a new place to put that, and that means a shiny new headquarters building. And for some companies, that means buying a building or even buying a land and creating the building and hiring expensive architects and having sort of the best of the best and making sure all their executives all have corner offices across many floors. And the fact of the matter is, once you add in all of those costs, by the time you've done that 2 or 3 years down the line, economic conditions have usually changed. And even if a company doesn't necessarily fail after announcing a new headquarters building, the fact of the matter is its share price is probably going to lag for a while. A great example of this is the company Apple. They announced their big new campus that they were building a few years back, and their share price ended up kind of going sideways for about 18 months after that. This is still a big and huge and successful company, really one of the most successful companies of all time. And even they had a struggle after they announced that they were building a new headquarters. Another example that comes to mind for me is a company called Thornburg Mortgage, which at one time was the largest publicly traded company in New Mexico. They were announcing a new headquarters building in the mid-2000s, but by 2008, with the housing price meltdown and how that was impacting mortgage securities, the company ended up going bankrupt, so they never even had a chance to move into the new building. And all the time in finance, when you see companies on Wall Street looking to relocate to bigger and newer space, you can probably expect some share price underperformance there. You might not necessarily get the kind of huge and negative performance that we had in late 2008, but it's still probably a good idea just to look elsewhere for profits for a while. Now, the second thing that a company can do to tell you maybe you should avoid it is that they're looking for new things to do. These new developments are outside their core area of expertise. So if Coca-Cola decides to buy a coffee company, that's great, they're still in the beverage industry. But in the 1960s and 1970s, Coca-Cola was flush with a bunch of cash, and they decided to invest in all sorts of things, including movie studios and golf courses. Now that's outside their core competency of selling soft drinks, and as a result of that, their share price lagged. And sometimes you'll see this where a company decides, our existing idea and our existing product, we're going to diversify, but we're going to do so in something that's completely and utterly off base. Right now, you have tobacco companies looking to buy into marijuana companies. That's a complementary industry. But a few years back during the Bitcoin boom, you had a couple of companies that were just looking to slap Bitcoin on their name, just in the hopes of playing that trend up. And that didn't work out well for a lot of those companies either when Bitcoin prices came crashing back down. So again, when you see a company saying, we're in business X, but we're also going to start doing business Y, that's a pretty good sign that you should stay away from it because they're probably not going to execute it as well as they would if they were in that industry to begin with. The third and final thing is something I've kind of noticed lately, and for lack of a better term, I'm just going to call it political correctness. This is a situation where the share price of a company falls because of bad news coming out about a company's, usually CEO or founder. We've seen in the past few years big drops. Wynn Casinos with Steve Wynn, a sexual harassment accusation came out against him. Last year, Papa John of Papa John's Pizza came out on a conference call, dropped the N-word. Again, share prices will drop because of things like this. So whenever you see someone making some off-color comment, the markets are actually starting to respond to that in a way you might not have necessarily expected them to in the past. While the business community can still be regarded as a big old, old boys network to some extent, and while, board members are often very cozy with management, this kind of behavior is getting founders of companies who are, in some cases, even the majority stakeholders of these companies kicked out of their CEO positions, and Papa John just resigned from the board of directors, which he was also on as well, and another company had to come in and give them an infusion of capital just to kind of help clear the plate on that. Now, the nice thing about this sort of thing is after there is that washout and after these people do leave, the share prices do tend to bounce. Wynn Casinos got a bounce after Steve Wynn left. Last year, after Papa John stepped down from CEO, the share price started climbing back up a bit. So it's sort of immediate bad news, but it could be setting up for longer term good news. So if you see anything in the headlines about some business executive who said something wrong, touched someone the wrong way, there could be a buying opportunity there, but give the dust time to settle, because in the short term, it is bad news. So these are kind of three areas that are not necessarily conventional financial metrics for determining whether or not a company is going to do well or poorly, but they generally tend to be bad news for a company's stock over time. So avoid those things, and hopefully you can find more profitable opportunities elsewhere. All right, that'll wrap things up for this edition of Trading Tips. Until next time, I'm Andrew Packer, wishing you good trading and good financial health.